How does the performance of index-based funds generally compare to the performance of actively managed funds? This is a tricky question because the comparison is generally not an apples-to-apples one. Traditionally, actively managed funds include the compensation costs for financial advisors, at least in theory. Whether or not you get any financial advice is a different story. But whenever you see a rate of return posted for a mutual fund, it's reported after fees have been deducted. Many actively managed funds have higher investment costs, but have additional costs for financial advice added in too. For the most part, index-based funds have lower overall investment costs and do not have financial advisor costs added in. Standard & Poor's publishes a scorecard known as the SPIVA, which stands for Standard & Poor's Index versus Active. This scorecard tracks the overall performance of mutual funds against their benchmark indexes. The exact numbers change from year to year, but not by much over longer periods. According to the mid-year 2014 report, only 19.57% of actively managed funds in the Canadian equity funds category outperformed their benchmark. But note that they are comparing actively managed funds with the costs of advisor compensation against the pure benchmark. Index-based funds will lag the benchmark by a small amount, and so if you compare the actively managed funds without the cost of advisor compensation built in to an index-based fund, the performance would likely be closer, but the conclusion likely still the same. So, on average, index-based funds generally outperform higher cost alternatives.